Most UK directors wait too long to think about closing their company, and this can mean the difference between walking away a millionaire and walking away with considerably less. So, in this video, I'm going to show you exactly how to shut down your limited company the smart way, how to get your cash out efficiently and effectively whilst avoiding harsh penalties, hours of wasted time and tax you really shouldn't be paying. I'll walk through liquidation versus strike-off, how business asset disposal relief, so BADA, really works, and when a £33 form beats a £10,000 process. If you're looking to retire, pivot, or just walk away, I made this video just for you. Before we get into it, step by step, let's start with something most people never think about. Closing down a company isn't just paperwork. It's often one of the biggest financial decisions you'll ever make. Do it right and you walk away with more of your money, fewer headaches, and a clean slate. Get it wrong, it could haunt your wallet and your record for years. So why do people actually close their companies? And what's at stake if you get it wrong? Maybe you're retiring and finally cashing out your hard-earned reserves. Maybe that side business just never quite took off and it's time to move on. Or maybe you're restructuring to focus on bigger opportunities. Or perhaps, thanks to constant losses, IR35 drama, or the end of bounce back loan support, it's simply more hassle than it's worth. Whatever the reason, knowing when to shut up shop is a mark of strategic genius, not failure. Warren Buffett probably said that, probably. And here's the real kicker. How you close matters way more than most people think. Whether it's a formal liquidation or a casual, thanks HMRC, we're done here, strike off. What you do now can follow you around for years, like a clingy ex or a badly written shareholder agreement. Whether it's formal liquidation or a simple strike-off, there can be consequences that follow you for years. There are 5 factors you've absolutely got to weigh up. Solvency. Can the company still pay all its debts in full within the next 12 months? Tax implications. It could be taxed as income, up to 33.75% if you're a higher rate taxpayer taking the money out in dividends, or capital, potentially as low as 14% with business asset disposal relief on final payout. Cost and complexity. Liquidation comes with professional fees. Strike-off is dirt cheap, but only if you're eligible. Timing. Some processes take 3 months, others can drag on for years. And if your year-end or personal tax status is changing, then timing is everything. And then personal liability. Directors can still be investigated post-liquidation, especially in creditors' voluntary liquidation, CVLs, which we'll cover later. But you can also be on the hook for company debts after a strike-off if it's done improperly. Think of it kind of like writing the final chapter in your business story. And yes, HMRC is reading over your shoulder. Botch the ending and it can haunt you for years. Unexpected tax bills, frozen assets, or awkward questions when you try to start something new. But get it right, you exit cleanly with more cash in your pocket, minimal hassle, and the sweet satisfaction of not giving the taxman a penny more than necessary. It's like a mic drop, but for directors. So let's talk liquidation, which sounds like a business funeral with sandwiches, but is often just a smart way to wrap things up and walk off with more of your money. Despite the dramatic name, liquidation simply means formally shutting down a company under the Insolvency Act 1986, which sounds like it should come with a theme tune and trench coats, doesn't it? It always involves a licensed insolvency practitioner, basically the business world's undertaker, and ends with your company being permanently deleted from Companies House like a bad ex from your phone. But here's what most people don't realise. There are 3 main types, and which one you pick hinges on whether your company's solvent or insolvent. And the 3 are, firstly, the best case, which is an MVL or Members Voluntary Liquidation. The second one, which is a tougher one, It's a creditor's voluntary liquidation, CVL for short, and the worst case scenario, compulsory liquidation. So starting with the best case scenario, MVL, members voluntary liquidation. Now this is for companies that are still solvent, meaning the total assets exceed the liabilities, so they can pay off every single last debt within 12 months. But the directors and shareholders want to close up shop and extract the remaining cash or assets out of the business. Think of it like closing down a successful pop-up shop at the end of summer. You've made your money, you've paid off the suppliers, and now you're just clearing out the shelves and pocketing up what's left. MVLs are especially popular when directors are retiring or moving on to something new and want to take money out in the most tax-efficient way possible. Here's how it works. The directors sign a statutory declaration of solvency confirming the business can meet all of its obligations. Then the shareholders pass a special resolution which requires at least 75% approval to appoint a liquidator. This is advertised publicly in the Gazette, and the liquidator begins distributing the company's reserves to shareholders once all debts have been paid. The golden reason to do it? Tax. Distributions made through an MVL are taxed as capital gains, not dividends. And if you qualify for business asset disposal relief, BADR, the tax rate drops to just 14% on up to 1 million of lifetime gains. So the total profit you've made from selling businesses over your whole life, not just this one-off. Now compare that to higher rate dividend tax at 33.75%, and it's a no-brainer. Be aware though, that rate is due to increase to 18% from the 6th of April 2026. So get it in quick. For example, if you're closing a company with £200,000 in retained profits, with BADR, CGT is 28,000 at the 14% rate. Taken as dividends at the higher rate, 33.75%, dividend tax would be 67,500. That's nearly £40,000 difference. It's huge. Yes, MVLs come with costs, typically around 4,000 to 10,000 in liquidator and professional fees, but the tax savings almost always outweigh the cost of liquidating when you're dealing with anything over 25,000. Now, let's move to a tougher but equally important route: creditors' voluntary liquidation, CVL. If your company can't pay its debts, it's insolvent, that's where a CVL steps in. So why do it? In a CVL, the directors propose liquidation and the shareholders agree by resolution, just like with the MVL. But then creditors get a say too. They're given the company's statement of affairs, which outlines all the assets and the liabilities, and they vote on the proposed liquidator. One key benefit of a CVL is that it shows that you're acting early and transparently, and that can reduce the risk of misfeasance claims against you personally as a director. Staff can also claim statutory redundancy pay from the Redundancy Payment Service, including directors on payroll, which for some on 30 to 40,000 salary with a 12 to 15 year service, that can be a £9,000 to £12,000 claim. But it's not without risk. The liquidator is duty bound to investigate director conduct, especially if there were late filings, unpaid taxes, or signs that the company kept trading while insolvent. Expect awkward questions because you might be asked to explain your decisions, defend transactions, or even repay funds if wrongful trading is suspected. It's not automatic, but it's serious, and your actions in the lead up to closure really matter. Finally, there's compulsory liquidation, the least desirable option. This is where a creditor, and it's usually HMRC, drags you to court over as little as £750 unpaid debt. If granted, control then passes to the official receiver, who investigates the company and its directors, freezes all accounts, and starts selling off assets. It's very public, very final, and it comes with a lot more scrutiny. You lose control of the timeline and your company's name is published in the Gazette. Even if you had intended to pay, once the court gets involved, it's often too late to unwind. It's messy, stressful, and completely out of your hands. So how long does all this take? Well, expect 2 to 3 weeks to appoint a liquidator, then 6 to 18 months for full dissolution, sometimes longer, depending on how long it takes to sell assets, settle claims, and finalise HMRC clearance. Costs vary widely, but they include liquidator fees, statutory advertising, and a bond to protect creditor funds, all paid from the company's remaining assets. So in summary, liquidation isn't some financial doomsday. There's no black cloaks or flaming spreadsheets, but done right, it lets you close down cleanly, extract value efficiently, and limit personal risk. Done late, it's more like trying to put the fire out after the taxman's already roasting marshmallows on it. If you're scratching your head over whether an MVL, CVL, or something else is right for your situation, book a free discovery call, links in the description. We'll walk you through the best fit option based on your assets, debts, and goals. Let's talk about the simpler, lighter touch alternative to liquidation, voluntary strike-off. This is the route most directors hope to take when closing a company. And why? Because it's fast, cheap, and doesn't involve courtrooms, liquidators, or anyone else in a pinstripe suit charging £400 an hour. But, and here's the catch, it only works if your company is squeaky clean. No debts, no assets, and no funny business. I'm not quite sure what funny business is, but business sometimes is funny. Think of it like leaving a rented flat. The place has to be spotless, all the keys handed back, and ideally no mysterious smells coming from the fridge. Do it right, and you walk away with your metaphorical deposit intact. Strike off sounds almost too good to be true, and that's because it kind of is, unless you follow the rules to the letter. It's governed by sections 1003 to 1005 of the Companies Act 2006. Don't worry, there's no test. And handled entirely through Companies House. If your company qualifies, you fill in a single form called a DS01. You pay your £33, and in a few months, poof, you disappear from the register like a magician who's tidied their affairs. But here's the catch. Your company has to be cleaner than a rented Airbnb after checkout. To be eligible, you must tick all of the following boxes. No trading name changes or major asset sales in the last 3 months. No ongoing insolvency proceedings. No debts. That means HMRC, council, suppliers, or any lingering bounce back loans. All bank accounts closed and no assets left hanging around, and no threats of a compulsory winding up petition. Miss even one of these and your strike-off could be blocked, reversed, or worse, get you a very stern letter from HMRC. Not quite the disappearing act you had in mind. Here's how it actually plays out. You file the DS01 form to Companies House, signed by a majority of directors, and you pay the £33 filing fee. Companies House publishes a notice in the Gazette giving creditors and stakeholders 2 months to object. If no objections are raised, a second notice confirms dissolution and your company is officially gone. So why do people do it? Because it's the cheapest closure method, just £33. And it's often resolved within 3 to 6 months door to door. It requires minimal professional help if the company's affairs are simple. But, and it's a big but, strike-off is also the riskiest if done carelessly. First up, forget to declare or distribute assets. Bad news. Anything left behind automatically passes to the Crown under bona vacantia. Now that includes bank balances, customer payments, laptops, even that domain name you swore you'd use someday. Once it's gone, Getting it back is like trying to buy your own stuff back on eBay. Fiddly, slow, and often more expensive than it's worth. Secondly, trying to strike off with debts, expect objections. HMRC in particular have the instincts of a hawk and the patience of a monk. If there are unpaid taxes, missing returns, or open time to pay deals, they'll swoop in with a big fat nope. Other creditors can object too, and they've got 2 months from the Gazette notice to raise their hand. And third, this one's big, directors stay personally liable if they dissolve a company knowing it has debts, or if they mislead creditors in the process. Even years down the line, a creditor can apply to have the company restored and come knocking. It's a bit like burying a landmine and just strolling off. Just because you can't see it doesn't mean it won't go boom. Creditors, including HMRC, can apply to have it restored 6 years. And once it's back, they can chase you with CCJs, court summonses, or debt collectors who seem to time their letters for maximum anxiety. And here's a common misconception. Just because your company hasn't traded doesn't mean strike-off is automatic. You still need to cancel VAT, submit your final corporation tax return, and settle any PAYE or NIC. Skip just one, and objections will come flying in, often from HMRC, who never miss a trick. Now, this one's important. Don't forget to close your bank account. Seriously, that I'll get around to it mindset can cost you thousands. If there's money left in the account when the company's dissolved, it gets claimed by the Crown. And I've seen this happen quite a few times. To get it back, you'd have to restore the company and possibly go to court. All that faff just to reclaim your own money. So when does strike-off work like a dream? Well, if you're a one-person company that stopped trading, if there are 0 debts and less than $25,000 in leftover cash or asset, if you've submitted final tax returns, closed accounts and tied up loose ends, if you want a clean, low-cost, no-fuss closure. And when should strike-off come with a flashy warning light? You've got a bounce-back loan. Strike-off is off limits until it's repaid. If there are unresolved HMRC debts or outstanding filings, or the company holds valuable assets which could be taxed more efficiently via a liquidation. So, bottom line, strike-off is only cheap if it's done properly. Do it wrong, it can cost you far more later in stress, legal bills, or missed tax relief. If things aren't crystal clear, don't guess. Get advice. At this point, you might be thinking, okay, this is useful, but how do I actually choose the right route? Well, let's break it down using a simple decision tree logic. There are 3 main closure options: MVL, members voluntary liquidation, CVL, creditors voluntary liquidation, and voluntary strike-off. Which one suits you depends on 2 crucial factors. Is your company solvent? What's the value of your remaining reserves? And here's the first and biggest fork in the road. Is your company solvent? Can it pay all its outstanding debts, including to HMRC, suppliers, staff, and lenders, in full within the next 12 months? If the answer is yes, then you're working with a solvent business. So that puts you on the path to either MVL or strike-off. If the answer is no, and your company is struggling with debts it can't clear, even if the bank account doesn't look awful, then you're dealing with insolvency. In that case, your options are CVL or compulsory liquidation if someone else, usually HMRC, forces your hand. Now, is the company both solvent and has less than $25,000 in cash or assets? Then strike-off may be your best option. HMRC allows final distributions under $25,000 to be treated as capital gains, no formal liquidation required. That means you might still qualify for CGT rates, including the new 14% BADR, and avoid paying a liquidator. It's the cleanest, cheapest exit. like leaving a hotel room with the towels folded and the minibar untouched. Doesn't happen in my life. But no bounce back loans, no outstanding VAT, and no half-finished payrolls allowed. Everything must be neat and tidy. But if you're solvent with more than 25,000 in reserves, now you're into MVL territory. And why? Because once you go over the 25,000 thresholds, any distributions made outside of the formal liquidation are taxed as income. So, for example, dividends, potentially at 33.75%, so it's a big chunk. That's where MVL saves the day. It unlocks capital gains treatment, and if you qualify for BADA, you're looking at 14%. Even at the standard rate of 24% CGT, it still beats dividends tax hands down. Yes, you'll pay for a liquidator, but the tax savings often far outweigh the fees. If you've got chunky retained profits and want to exit smartly, MVL is usually the winner. Now, what if your company is insolvent, but no one's come knocking with court papers yet? Well, now's the time to act. This is where CVL becomes the smart choice. If your company is in financial distress, but you act quickly, you may still have time to arrange a creditor's voluntary liquidation, the CVL. You can work with a licensed insolvency practitioner, notify creditors, and shut down in a structured, responsible way. And bonus, if you're on payroll, you could qualify for director redundancy, often worth $9,000 to $12,000, depending on age, service, and salary. It's paid from the redundancy payment service, not your company's bank account. Plus, acting early helps protect you from accusations of wrongful trading or playing favourites with creditors. Have you already received a statutory demand or winding up petition? Strike off and CVL are probably off the table. You're now facing compulsory liquidation, where a creditor, usually HMRC, applies to the court to wind up your company, and it only takes 750 of unpaid debt to trigger it. Once that ball starts rolling, it's public, messy, and very hard to control. The official receiver will take over. They investigate everything and you're no longer in the driver's seat. Best thing you can do at this stage, cooperate fully and protect your own position. So you've figured out whether you're heading down the MVL, CVL or strike-off path. But before you file anything or pay a liquidator, there are a few essential steps that can make or break the closure. This is the stage where most directors make mistakes, not out of bad intentions, but because it's easy to miss a form, forget a registration, or assume that something has already been dealt with. HMRC, however, doesn't work on assumptions. Let's run through the big 5 classic mistakes that trip people up and how to avoid them. Firstly, tax timing. We get it. You're ready to be done. But filing a DSO1 before sorting your taxes is like announcing your retirement before finishing your last shift. And you risk HMRC objections dragging things out for months. Before strike off, make sure you've filed your final CT 600, you've submitted full statutory accounts, you've paid all remaining corporation tax, and you've cancelled VAT, payroll, and any other registrations. File the DSO1 too soon, and HMRC will object faster than a toddler being told it's bedtime. Number 2, outstanding government-backed loans. Strike-off is barred until repaid. You need to keep your eye on any outstanding government-backed loans like bounce-back loans and SIBILs. They were critical lifelines for thousands of businesses, but there's a hard rule. You cannot strike off a company that still owes on these. Even if the company is no longer trading and has no other liabilities, you can't use strike-off to sidestep repayment. Doing so is considered misuse of public funds, and HMRC or the British Business Bank will object immediately. If you can't repay the loan, then a CVL is the correct route, and it's important to act before further interest and charges accumulated. Next is director redundancy. Don't overlook this one in CVL, and this one surprises a lot of directors. If you've been on your company's payroll, even as the only employee, you could be entitled to redundancy through the redundancy payment services. Typical claims for eligible directors are between $9,000 and $12,000, depending on your length of service, got to be 12 to 15 years, your weekly salary must be regular and provable, and your age at the time of liquidation. That redundancy payment is funded by the government, not the company, and it doesn't need to be repaid even if your company's balance sheet is empty, but you must go through a CVL to access it. If you're unsure whether you qualify, we can help you review your PAYE history and check eligibility before you proceed. Then we've got record keeping. You still need to store documents for 7 years. A lot of directors think that once a company is closed, the paperwork can go in the bin. Not true. Under UK law, you're required to keep company records for 6 years from the end of the accounting period, whether it was closed via strike-off, MVL or CVL, and that includes bank statements, invoices, tax returns, payroll records, board resolutions and director minute. And yes, HMRC can still request them. If you've disposed of them early and get investigated, HMRC will simply assume the worst and estimate any liabilities in their favour, not yours. Now, digital storage is fine. Use Google Drive, Dropbox, or even a USB stick. Just make sure you can access them if needed. And then lastly, engage the right professionals sooner rather than later. Here's one we see all the time: directors waiting too long to get advice. In MVLs, waiting too long can mean missing the year-end tax windows or triggering a dividend tax charge instead of CGT. In CVLs, acting too late can raise questions about trading whilst insolvent, especially if large payments or dividends were taken recently. In strike-offs, failing to clear one last PAYE account can derail the whole thing. A quick planning session with a licensed insolvency practitioner or tax accountant can prevent years of headache, especially when it comes to director redundancy claims, BADA eligibility and HMRC objections. Closing a company isn't just ticking boxes and shutting the doors. It's your final big business decision. Do it right and you walk away with more money in your pocket, a clean slate and 0 sleepless nights. Do it wrong and you'll be haunted by tax bills, creditors and what-ifs for years. So take a breath, plan it properly and give yourself the kind of exit your hard work deserves. If this helped, give it a like or share it with that mate drowning in paperwork, and I'll see you the next time.